Hello there. Today we'll be taking a dive into some stock talk with the price to earnings ratio, where you can find it, and how it can be used to evaluate stocks, along with useful formulas and benchmarks. I'm Jordan Collier, and this is the Storybook Wealth Builder channel, which seeks to provide net of expenses exposure to sustainable wealth creating solutions for your storybook journey. The price to earnings ratio, or earnings multiplier, is the ratio for valuing a company that measures its current share price relative to its earnings per share, or EPS for short. Investors can use the PE ratio to determine the relative value of a company's shares and even others in similar or different sectors. Think energy, utilities, financials, etc. The ratio can also be used to compare performance against past earnings in historical data. Personally, this was the first metric I used when investigating stocks as a primary purpose to determine if a stock was overpriced. Using this ratio alone when first looking at stocks makes the process of evaluating more manageable as you get your bearings on the key stats that are presented. Alone, the PE ratio does not tell the whole story, but to quickly get a take on what a company's earnings are like helps with formulating an early opinion. Now, let's see where we can find that information. In Benjamin Graham's book, The Intelligent Investor, Graham, who at one time was Warren Buffett's mentor, recommends a helpful way to calculate an adequate price to earnings number. If you don't already have it, download the Yahoo Finance app, which is free, and is a great tool to use to explore stocks or any other asset class you might be interested in. For this example, we'll use Finning International. Now, when you hit the stock that you're interested in, this is the first screen you'll see. Once again, I'm also reviewing this on an iPad, as most of our investing is probably going to be done on the go with whatever mobile device you might be using. So instead of under summary, we'll head over to details. Under details in the financial section, hit view all. This brings up a financials tab. Scroll all the way down until you get to basic EPS, basic earnings per share. You'll notice there's three numbers in the column. That represents earnings per share in years 2019, 2018, and 2017. What you want to do is add those three numbers together. Whatever the total is, divide by 3 to get an average. Then whatever the stock price is, divide the stock price by that new average, and you'll get a price to earnings ratio. Graham insists on calculating the price to earnings ratio based on a multi-year average of past earnings. That way, you lower the odds that you will overestimate a company's value based on a temporary high burst of profitability. Graham used 15 price to earnings as a benchmark for reasonably priced companies. If a company comes out of the equation higher than 15, you can reverse the equation and go 15 multiplied by EPS to get the stock price that would suffice the 15 price to earnings threshold. If you found this video helpful, please do the cliche thing and super smash all the buttons of the like and subscribe variety. Be sure to leave a comment, as it helps me better tailor content for this channel. Until next time, see you later.